Cash your gains. I mean, really cash your gains before it's too late. Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Growth investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. I am with my co-host Véronique. How are you doing today, Véronique?
That was an interesting hook, Mike, like really serious and really like dramatic. I liked it.
Well, we have to do things differently sometime from time to time, right? I mean, if not, I'm not going to catch like the attention of listeners. So there you go. We're going to talk about selling today, but not selling the loser stocks or the bad ones, right? So we're going
Right.
outside of that spectrum today.
Actually, we often talk about like the struggle to sell losers, but we rarely hit the other side around, which is selling your winners. Like this doesn't make sense, right? But we'll explore why it's essential today.
Yeah, I mean, I kind of feel sorry for people that are cashing their gains at like up 25% or 50% or even 100%. So a lot of investors have those rules and they're going to say, you cannot lose money if you sell without a profit. I'm like, yeah, but maybe you could have made a lot more. There's an opportunity cost of like following those strict rules. So I have a different kind of strategy to talk about how to sell your winners, but let them run a little bit longer to make sure they generate maybe 300, 500, 1,000%. That could be cool. So we have something for
Mhm.
you guys.
And Mike, I'm just gonna throw a name before we start Broadcom.
Ah! Well, I mean, funny story. I had Todd, and I want to say hi, Todd, because we have like plenty of conversation together. He's, of course, a DSR Pro member. He thanked me about Broadcom. So that was kind of like a bittersweet, but he told me, like, I used your rule to cash some of my gains on this one. And I'm like, yeah, I bet you are so up in your portfolio, and I'm not. But anyways, there you go. Thanks, Vero, for reminding me. I don't know what hurts
All
more,
right.
like Broadcom or Algonquin. I don't know. Probably Broadcom.
All right, Mike. So let's start by going back to the title, like sell your winners before it's too late. Like what makes now the right time to talk about this? Like are there signs that we might be nearing crisis? Like are there like market recession expectations on your side to say that?
Yeah, I mean, let's not be like we were dramatic to start the episode. Now let's level down a little bit. We should have changed the title to be completely fair to trim and not sell, but that would not have been great. So I'm all about trimming and not necessarily cashing the entire position. And we're going to get there in a second. Why now, though? That is quite obvious. We don't know when the market correction is going to happen, but whenever you are at a all-time high, which is pretty much the case every single week right now, it's kind of crazy. Sometimes I just like look at my portfolio, I'm like, how the hell it's still higher and higher, like month after month. I just don't believe it. But it's a good timing to clear some of those positions, to do some cleanup. You know, when the tide goes back down, you realize who's swimming naked. And my bet is we're going to see a lot of people that were not wearing bathing suit when it's going to go down. So might as well make sure that you focus on quality, that you focus on a good diversification, and you're not like 80% of your portfolio is invested in Nvidia because it has been a great pick. Maybe at one point it's time to trim all.
Okay, so let's talk emotions. Why is it so hard for investors to sell their winners even when they know they're overexposed?
I would call it greed, which is totally normal. I mean, you made the research, you made the effort, you picked a winner. It keeps on going up, making money and making more money. And our brain has a weird tendency. It always tries to predict this future. And I mean, we should have learned by now that we're not that great for that. But as it is the case for a stock that goes down and goes down and goes down, I mean, if you see a straight line going down by like 25% over the past 9 months, your brain is automatically raising the red flag saying, Mike, it's going to continue to go down. Obviously, look at the trend. Well, when it goes up and up and up, and up, you just say, the other investors don't get it. It's going to continue to skyrocket. I'm making so much money. I'm a genius. And this is what happens. And I get that. I mean, I'm the first one who always cringe a little before I hit the sell button and trim some of my winners position, because I'm like, dude, I'm making money right now. Why in the world would I get rid of like my best players? It's like asking to trade McDavid at its prime. You want to keep it to yourself, but I mean, he's not eternal. And one day he's not going to rack up like 150 points. So that's the
Mhm.
point here as well for the winners. They're not going to go there forever.
But at the same time, you think that we shouldn't cap the upside of our best stocks. So what's the danger in selling like too early just because it's like as like doubled or tripled?
Well, most of the time, investors don't really know why a stock goes up or goes down, actually. So when it's up like by 100% or tripled in value, as you mentioned, then they're just saying, oh, I'm going to cash my gain because I got lucky. I'm going to cash my gain. But maybe this company is set to continue going up. Like you mentioned, Broadcom, but I mean, it's one out of like several other examples. But think about that. You did the heavy work, you did the research, you bought with conviction, you follow this one. It's great. So, what if you sell it too early? Well, there's a huge opportunity cost. So, you want to let your winners ride as long as possible. I mean, it's like again, hockey players. I mean, right now, I don't know. Like at the time of recording this episode, McDavid did not sign his contract yet, and I know it's a big
Hmm.
source of concern for the Oilers fan, and I would be concerned too, actually. But of course, if you are the GM, you want to sign McDavid for as long as possible. But on the other side, at one point it's going to stop. So if it was possible, you wouldn't probably not sign McDavid for 25 years. You would probably go for maybe 10 years. All right. But above 10 years, there's a blurry line here. So you want to let your winners run more for the opportunity cost. You certainly don't want to lose a star player like this in your portfolio at its prime and let him it go. Like that doesn't make any sense. You want to keep those. It's already hard enough to find those kind of companies in your portfolio because you're not going to hit that home run every single time. So when you have one in your portfolio, you might as well keep it as long as you can.
Okay, but today's episode is based on one of your selling rules, Mike, which is sell a winner when it exceeds your risk exposure limit. Can you explain what that means in practical terms?
Yeah. So risk exposure. The thing is, you have been right for a while having this stock in your portfolio. But what if one day you are wrong? What if this company, and that's why a lot of investors will cash their gain at a specific limit in terms of percentage, just thinking, well, I'm going to benefit from that while I'm making money because maybe I'm going to hold it too long and you go on the other side. So that's the risk exposure. So what I do is I look at my portfolio and I imagine myself that I'm wrong on my biggest holdings. And then being wrong for me means losing 50% of the value. The point here, by losing 50% of the value, that shows a big impact on my portfolio. That is easy to put a dollar amount to that risk, and then I can decide if I'm comfortable or not. So what if I lose 50% of 10,000? Okay, so that's 5 grand. Am I okay losing $5,000? Maybe yes, maybe no. And the answer to that question will be different from one investor to another, and that's totally fine. The point is not to follow exactly the rules that we're going to develop today, but rather to have this framework of what if I'm wrong on a stock? What's the maximum I'm willing to accept as a loss? And this is why I use 50%.
Okay, but Mike, the example of 50%, it's a bit extreme, right? Like it doesn't happen like really often. So why use such an extreme scenario?
You're totally right. It's very possible that your best winners are going to go down 20% and you won't even feel it, right? I
Mhm.
go at 50 because I want to get rid of that dilemma. I want to get rid of that doubt. So if you go to the extreme, it drives to take binary decisions. It's a yes or no
Mm.
answer at one point. I mean, it's like if I asked you, would you prefer me giving you $100,000 or you giving me $100,000? I mean, the choice is quite obvious, right? You want
Right.
to give me 100 grand. but but by pushing to the extreme, it automatically becomes clear. So you don't have to wonder, oh, what if this, what if that? I'm like, yeah, no, like losing 50% of that stock, no way, I'm not good for that. So therefore, I'm going to trim.
Okay, but how did you personally decide what your risk exposure limit was, and how should listeners figure out their own number?
So yeah, so losing 50% of a trade is not really telling you like the real number at this point. So because if you have like $2,000 invested, you probably don't mind if like your biggest position is $500 and it goes down to 250. It could go down to zero, probably not going to move the needle. So what I'm doing is I ask myself how much I'm willing to lose in terms of dollars. And again, I'm going to go with extremes. So imagine that you have $1,000,000 invested just for the fact that it's like super easy to picture in terms of number, right? So it's not necessarily, it could work for 100 grand, but let's go for 1,000,000. So would you be okay losing $500,000? I mean, probably not. I mean, imagine that you have like one stock in your portfolio that is worth $1,000,000. The worst that could happen, it goes down by 50%. You lose 500,000. Definitely, you're going to say, yeah, Mike, no, that's way too much. I need some diversification. I'm like, all right, that's fine. So imagine now that your biggest position is like $200,000. Are you comfortable of losing 100K? 100K on 1,000,000, that's 10%. Am I willing to do that? Probably not. That's way too much. So then you go down. Are you willing to lose 50K? So then some people will say yes, some people will say no. And in my case, this is where I draw the line. I draw the line at 10% of holdings. So the major correction, or if I'm like completely wrong, I would lose half of that, which is 5% of all my investments. So I'm not talking a specific portfolio here, but really all my investments. So even if I, for example, I report my pension plan portfolio, you may find from time to time a position that is above 10% of that portfolio, but it's not 10% above all my investments. And this is where it's
Mhm.
important. It's really all the accounts that are used for me to retire one day. They have the same purpose, so they are invested the same way. But as a classic Canadian, you will have like 5, 6 accounts. If you manage your spouse accounts on top of that, you're going to go up to 10 easily. So that's why it's important to have a global view and see what's your total exposure to one stock across all your investments. Personally, I draw the line at 10%. So any stocks that goes at 10, I'm going to trim to reduce that position because I'm not willing to lose a total of 5% of all my investment. For somebody else, the answer, going back to that $1,000,000 example, would be $25,000. Like anything under $25,000, willing to lose it. So therefore, we're talking 25,000. So that means your position is maximum 50. 50 is 5% of the portfolio. So whenever the stock goes above 55%, you trim. And by trimming, you don't have to sell the entire 5%. You can trim like one or two. Most of the time, that's what I do when I reach 10%. I go back to 8, like between 7 and 8, that's enough. I trim a little bit. So that enables me to let the winners run so much longer because I still have a lot of shares. I'm just taking some profit off the table to rebalance the portfolio.
But then, Mike, like, I think it's important that we need to look at sector allocation at this point, because if you have like 10% invested in a single stocks, but then a lot of your stocks are, for example, into the technology sector, and the technology sector gets hit, it's not only 5% that you're going to lose in this point of view, right? So that's very important also to take into
You
consideration.
bring a very good point here. When it comes down to sector diversification, I mean, of course, if you have like one stock that is like 10 or 15% of your portfolio, chances are you're going to be overweight in that sector. Then what you need is to have great diversification among several industries. So, for
Hmm.
example, if you have like a software company and then you have semiconductor one and another one that is focused on consumer electronics, it's going to be a little bit less impactful. But still, again, if I sell one of those stocks in the technology sector, to get your example, I would probably use that money to invest in another stock, but also in another sector, just to make sure that I'm still well diversified. Personally, I draw the line at 20%. 20% starts to become a red flag. Above 30, I need to do something. So sometimes it will happen that my biggest sector will be around 25%. I can live with that if it's invested in different subsectors or industries, so I can actually not be so much exposed. So I love to take the example of Canadian banks in the financial sector. So having 6 Canadian banks in my portfolio, I don't see that as a diversification. But if I invest in 2 banks, one life insurance company, one payment processor, one asset manager, and one stock exchange company, then I'm well
Mhm.
diversified in that sector and I could live with 25% of my portfolio.
Right.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see 2 very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. Our goal is to help more investors just like you, so please spread the love. Thank you.
Okay, so is there ever a time when you'll trim a winner, even if it hasn't hit that limit of 10% in your case yet? Like, for example, alimentation couche-tard, because we need to talk about it in every
Yeah,
episode.
yeah. It's been a couple of episodes that we didn't mention it, right? So,
So ATD like results have weakened lately. Would
mhm.
you be tempted to trim before it hits your 10% limit?
Well, funny enough, I did trim Couche-Tard in the past because it was above that 10% limit. But at this point, it would go down to my other rules of selling because I actually have 4 rules. The one that we talk about is really about selling your winners, but I have also 2 others that could apply to a winner or to a loser. And it's all about my investment thesis. So the reason why I believe Couche-Tard is a good company or not. If it's still valid, I'm going to hold on those shares. And the other thing is if the dividend triangle, the financial metrics back this investment thesis or not. So at this point, we're 2 years in where we have weaker results. So the dividend triangle
Mhm.
is getting weaker. So that is not helping me right now making that decision. But my investment thesis remains very strong. So at this point, I will wait another full year just to see where the company will go. Because right now they have a plan. The revenue still increases. It's still a bit harder for the earnings. So I'm going to wait to see if they are able to turn things around. Usually the waiting time for such a great company will be 3 years, where what I want to see is the management has a plan and is the numbers are going to like turn around and eventually go back to growth. If they're able to do that, well, I'm going to keep it. If not, then I'm going to sell. I'm not just going to trim, I'm going to get rid of the position. The point here is if my investment, and this is one thing that I've learned from Algonquin actually, which was an extreme case. I had a
Mhm.
strong investment thesis, but I kind of like didn't give enough weight to the numbers. So revenue kept on increasing, the dividend kept on increasing, but the earnings were going down and the funds from operations per share was also going down. And this should have been my red flag to sell before it's too late. Since then, I put more emphasis on numbers than I do on the investment thesis. So maybe in a year from now, I'm going to sell Couche-Tard, and it's not going to be from a lack of conviction or from a lack of a strong investment thesis. But if the numbers are not there, well, I'm going to sell and I'm going to move on. The good news is if it happens, I'm still going to make a ton of profit on it. So it's going to be a great thing. But this is what I did with BlackRock and Texas Instrument at the end of 24. I still love those 2 stocks. I still have a strong investment thesis for them, but I didn't like the fact that BlackRock kept increasing their dividend around 2% a year. I focus on stocks that increase their dividend by 5 to 10% a year. So after
Mhm.
3 years, I had to let go. For Texas Instrument, the entire dividend triangle started to get weaker and weaker. So I was like, you know what? Love the stock, made a great profit. The company was skyrocketing at this point. I mean, more than 100% profit on it. But that was not the point. The point was going back to my investment rules. And the investment thesis worked. That's fine. The numbers didn't. Well, there you go. You sell, you're done, and then you move on. So I did not trim that position. I just got rid of it altogether. So that could
Mhm.
happen to Couche-Tard. I don't know yet. The numbers are going to decide. What is great is I don't have to think about, oh, do I believe in Couche-Tard going forward? Because I mean, you can believe in a stock for like decades and be wrong, right? But the numbers are going to force me to make a decision. And I
Mhm.
save some time, I save some stress. I don't have to doubt myself. I just have to follow the numbers.
Okay, so just to make it clear, you will sell winners when they either like take too much weight in your portfolio, so they exceed your
Mhm.
exposure limit of 10%. If the investment thesis is wrong, if the dividend triangle is not going in the right way for a long period of time. Are there any other situation when you'd consider selling a winner?
At this stage, no, but I can see myself doing that for tax optimization at retirement, especially with a
Mhm.
non-registered account. So in terms of like creating this cash reserve that we often talk when it comes down to retirement, at one point you need
Right.
to have some free cash. And if you're looking at your tax optimization between the different sources of income that you're going to receive, between the money that you may be withdrawing from a Lira account, RSP, or a RIF, well, then maybe sometimes it's best to sell some shares, trigger the capital gain on a specific year. So therefore, it would be a good strategy at this point, but that would be purely for tax optimization. And then you reallocate the money elsewhere in a better portfolio. So it's in a better, like another sector to have a better portfolio.
And is trimming always like the best move, or are there times when it's okay to let a stock run beyond your usual limit?
Well, when you look back, of course it's obvious, right? You say, oh, I mean, technically, I trimmed Apple, I think like 3 or 4 times already.
Right, right.
Looking back, I probably should have like kept all of those stocks and let Apple become 30% of my portfolio. But that's easy to say today. I prefer to be on that side than on the other side saying, oh my God, I never sold Algonquin. It was 30% of my portfolio and now my portfolio has been crushed. So I
Mhm.
prefer to look forward. I mean, it's like when you're raising a kid and you are telling your son, oh, if you don't do your homework, you're not going to have your phone tonight. And then your son's
Mhm.
like, well, I'm not going to do my homework because I'm a badass teenager. And then you're just like, okay, whatever. This time you have your phone, but the next time you won't. What do you think is going to happen next time? He's going to try it out again. That's a simple situation that can easily get out of control. Because if you keep on doing
Mhm.
that, after a couple of months, it's going to be pretty much anything that you say that has going to have a consequence. Well, the kid's going to think, well, I have a 50% chance it's not going to happen. So I'm going to take that chance. And I mean, they're not necessarily always good at math, but for those kind of maths, kids are amazing. So that becomes a bigger problem because if you do that with your portfolio, you're going to do the same thing. Oh, yeah, well, this time I let it run and it worked. So next time I'm going to do the same thing. And therefore, you don't have a rules anymore. You just like following the market, following how it goes, and thinking everything's going to be fine. And it's actually very easy to think that everything's going to be fine right now because the market keeps going up. So we become complacent. We think that we figured it out. We think that we know
Mhm.
everything and that we did our studies and did our research and we know that we are fully shielded against a correction. Well, we're not. And this is the perfect time to take a look at your portfolio for that reason. And this is why I rather follow those simple rules. I mean, it takes me literally 2 minutes. I mean, you pull out your global view of your portfolio, you see that one is at 10%, and then you sell. You don't have to ask anything.
Mhm.
You sell like 2-3% and then move on. And there you go. It literally takes 2 minutes to do the entire operation. And I love the fact that it's simple like this.
And I really like your comparison with like raising children because some people may not know this, but we're dealing with ADHD at home. And at some point we needed like guidance because we were like, I've never experienced that before, right? So anyway, just to say that the psychologist told us like the human brain works a lot better with a frame. Like
Mm-hmm.
adults, children, everyone needs a frame. When you don't have a frame, you do like pretty much anything or everything, right? So that's exactly what rules when investing are for, to give you a frame and know like I'm not going beyond that, right?
There you go. And it makes your life and your son's life a lot easier this way as well, because he
Right.
knows exactly, oh, if I'm stepping out of the frame, I'm going to get into trouble. So that's obvious, that's simple. Chances are he's going to try a lot less. Of course, once in a while he's
Mhm.
going to try it, but I mean, that's that if they wouldn't be teenagers if not, right?
Right. Okay, so Mike, you've mentioned trimming Apple many times on the show before and today. Are there other examples from your portfolio and how did that decision play out over time?
Over a long period of time, terrible decisions. That's the funniest part. I trim Apple a few times, as I said. Microsoft was another one. However, what I want to highlight here, which is really interesting though, is at the end of 2021, I trim Apple and Microsoft at the like right before we enter into 22. And in 22, both stocks were down like 25, 30%. And a lot of people ask me like, how did you know? And I'm like, I didn't. I just followed my rules. So, yes, after that, they recovered, but that enabled me at that time, at the end of 2021, to take that money, reallocate it into other stocks, being more diversified and actually suffer less in 2022. So, yes, it is more short term view, but sometimes for investors, it's also better because they get concerned, they get stressed. And I mean, on my side, would have not made a big difference in terms of like, I don't really care. I could lose half of my portfolio tomorrow morning and that would be fine. But I know that if I follow those rules, I will have a stronger and more balanced portfolio. I'm super happy today to have trim Couche-Tard in the past, though, because I didn't necessarily trim at the highest price, of course, because you never know what's going to happen. But I know
Mhm.
that this money was reallocated into other performing stocks. So that is
Right.
also the point where, and you know, I need to bring back the hockey analogy again, but I follow a podcast where they're a big fan of reconstructions. And what they're explaining, like for the Penguin Pittsburgh, for example, is they should have started their reconstruction like 3 years ago. They should have traded
Mm.
like the Crosby, the Malkin, the Letang faster so they can get a lot more for them. So it's the equivalent of trimming at the peak so you can get better
Right.
players, better draft down the future. Now you're stuck with like more older, mature companies that are not generating as many points as they used to, same as the hockey players, and now you want to trade them. Well, you're not going to get the same value as you would have 3 years ago. So Sidney Crosby, if you listen, you have to sign with Montreal Canadiens, but that's just me. And
We
and
will
and
be
do a
glad
good
to have
deal
that.
because we don't want to give away Caulfield for that. So, anyways, just saying. But yeah, that's the whole point. The point is really to rebalance your portfolio, even though when you look at it, sometimes you get and you're going to have sometimes stories where your super great winner becomes like a dud. That happens so many times in the past, and it's going to happen in the future as well. And there's no way to make the difference between a company that used to be like IBM, for example, and then was like dead money for 10 years versus, oh, I'm going to hold on to Microsoft. Not all stocks are going to be IBM's, not all stocks are going to be Microsoft, and a lot of them will be in the middle as well. So the point again, diversification, simple rules make it a lot easier.
So, Mike, you obviously don't regret your decisions, but what would you say to investors like maybe dealing with the fear of missing out right now?
So I used to sell winners after a good run. So I totally get it. You know, you get a good run. And actually, this is how I started investing before I had a strategy. Every single time I was making a quick profit, I was just like, yeah, I'm done. I'm out. I mean, put money. I mean, you're happy when you sell and you make money. Like, of course you feel
Mhm.
good. But the thing is, you always wonder, should I keep on holding? Should I trim a little bit? Should I sell completely and move on? And then when you move on, what do you buy? Is it going to be as good as your previous trade? And then you become kind of like a momentum or day
Mhm.
trader, stuff like that. So I prefer to take out the doubt and the dilemmas. And I mean, let's be clear, we have no clue what's going to happen in the next 12 months. It's impossible to know. A lot
Right.
of people will tell you, but they have no clue. So you might as well have simple rules to follow. And the example of what I've shared today, having like a specific limit of how much I'm willing to lose on a single stock. That would be true for a sector as well. That would be true for your
Mm.
entire portfolio. If you're about to retire, maybe you're going to say, well, investing 100% of my portfolio into the stock market, way too much cowboy approach for me anymore. I cannot live through those fluctuations, and that's fine. Of course, you're going to make less returns. But again, as we discussed last week on an episode about choosing a strategy, the point is not to maximize your return and beat your neighbors and beat the market. The point is to achieve your financial goals. And to do that,
Mhm.
you need to know what you do. You need to have control, and having a frame like you talked about, having simple rules, make it so much easier to follow. So you don't have to take my rules. You can make your own. The point is to believe in them and please follow them because there's no point of having a rule if you don't follow it.
Right. Okay, so today I invite listeners to join our free newsletter, the Dividend Guy newsletter, like pretty obvious name, right? Because we offer resources to help those struggling with both selling and also buying decisions, right, Mike?
Yeah, so I worked on a completely new series on the buy and on the sell struggle. So what happened is over the past few years, every time that I survey my members at BSR and I ask them like, what's your number one problem when it comes down to investing? It comes down to the two things: what and when to buy, what and when to sell. So for them, I completed like 2 major newsletters explaining them step by step how to do that. And you get a chance to have a glimpse of that work through those email series where we walk through most of that newsletter day a day at a time, so you can digest the information, build yourself a great framework, and then take actions based on easy to follow investment rules.
So make sure to register for our free newsletter now at thedividendguyblog.com/newsletter to get our best tips to solve your sales struggle. Thanks, Mike, for joining me again on the show. It's been like, what, 249 episodes.
It's
So
about
for
time
the
we
show
close down
notes.
that show now. Wait, we way too much talking.
So for the show notes and related content, visit thedividendguyblog.com/249. And please don't go just yet, like just a couple seconds more, because you want to hit pause and the subscribe button underneath our podcast logo so you don't miss any episode. And until next week, stay invested.
Stay invested. Hey, fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence, as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.